Hey, what's going on, ladies and gentlemen? ANZD here, back at you with another video. In this video, we're going to talk about that FOMC meeting, the interest rate hike that they went through. So the FOMC just recently had a meeting, the Federal Reserve Bank, the governors, the branches, the 12 members of the FOMC just had a meeting, and they decided that they're going to raise the federal rate hike by another 25 basis points. Kind of come by a shot because they was going for another 50 basis points, but because of what's going on with the bank and things like that, not really forced to, but in a way kind of slow down on the interest rate. So they're going to be doing a 25 basis point hike, and also they're going to be changing some of the guidance going forward. They're going to be looking at it a different way for the ongoing hikes. They're going to talk about some policy firming and changing the way they're looking at the outcome, and going forward how they're going to do the interest rate hike. So a lot of problems that they was facing at this meeting was problems in data that came up from the CPI data. You can check more information in the video. I think it's this video right here, the link. So check that out. Some more information on the last CPI data and the last CPI meeting. So a lot of the information that came in from that data wasn't quite as what the Federal Reserve was expecting. So some of it was like job vacancy was high, but at the same time there was a lot of jobs that was added to the market. So the growth in job market was higher than expected, even though unemployment went from 3.4% in January to 3.6% in February. The job market, they don't want the job market to be growing that much. They don't want hundreds of thousands of jobs getting added to the job market, because they want the labor market not to be so tight, because it can lead to wage increase. A lot of people are going to be having wage increase because got to pay, these companies are paying people more to stay there, and with those wage increases, prices of goods and consumer goods and services are going up, so people got to deal with that. So right now it's like the Federal Reserve is looking at it like too much people are working right now, so it's going to be even more tightening on the labor market. We're going to see more people getting laid off, more unemployment. The unemployment market probably go up to like the 4% range. Right now we're at 3.6%, and it might even touch the low 5%, 5.1%, but they want it to be in the 4% range, which might means about 2 million people will be unemployed, 2 million job loss between now and the summer of 2024. That's what they're aiming at. So the housing market is weak, so they also looking at that. With the housing market being weak, GDP is below median expectation. So that's another thing that came into the issue at the FOMC meeting, where they have to look at how they're going to raise the interest rate hike going forward. Inflation is still rising, because we can tell by the last CPI data that it's still rising. And check out the information in the other video that I'm going to post right here. Check the link. Federal fund rate now is at 4.6%, and they're projecting that they want it to go up to between 5.0% to 5.2%, with the expected rate being 5.1% within a year or so. So that's why they continue to raise these interest rate hikes, even though they kind of went back to quantitative easing because of what happened with these banks. They end up printing some more money to put back in order to help out the banks, such as Signature Bank, such as SVB, such as One Republic. So it's those banks right there, in order to help out the people who have money deposited there, and having the FDIC being able to cover it. The Federal Reserve is printing up more money to help out with that right there. So they're kind of going back to quantitative easing instead of quantitative tightening with the rates of interest. But they're saying that they won't be doing any in reverse. They won't be doing any cutbacks or anything like that. So they projected that they want it to be about 5.1% within the next year, like we said. And the FOMC will continue to monitor the rates and going forward at the different meetings and the outcome of these interest rate hike on the economy. With these meetings, they're looking to bring interest rate back down to 2.0%, which is going to be tough to do, because right now inflation is up, what the last one was about say 6.4, something like that. But between 5.9 and 6.4 is where it's at right now. But they wanted to bring it down to 2.0, which is going to be very hard. So what they're going to be doing is tightening credit conditions instead of more interest rate hikes. So going forward, instead of doing another 50 basis point or another 75 basis point increase, they're going to probably do a slower increase at 0.25%, in addition to tightening up the credit conditions in the credit market. So changing up how people are approved for credits and how companies get approved for credit and how the big business get approved for credit from one another bank. So policy firming will also be another topic that they will be focusing on in order to slow down on the inflation rate, reflecting on uncertainty that's coming forward. So they're going to put that into place, as well as measuring the numbers along with the CPI data. Stronger inflation and stronger labor market is what we're currently at right now, and it might lead to higher interest rate hikes because people are getting paid more because companies are paying out more in order to keep people there, and also more jobs are getting added to the job market. So those are going to lead to higher interest rate hike. So if people start getting laid off and companies start cutting back on jobs, like Amazon just cut, I believe, 9,000 or 10,000 jobs, and they will be cutting more. Also Facebook, I did a video with that, people cutting companies will be cutting jobs and doing layoffs, and you can check the link right there. In addition, we have the banking crisis. We have a lot of people that are in crisis because they were banking with these banks. They had small companies, they had startup companies that was banking with these banks, such as Silicon Valley Bank, Signature Bank, One Republic, Silvergate, wide variety of things going on with the banking crisis. So it's also putting a damper on the inflation, in addition to the Fed rate hike. So remember, they said they was going to probably go with a 50 basis point, but instead doing a 25 basis point. The banking crisis is going to have many reviews, supervisions, and regulations on the way, coming from the Federal Reserve as well as from Congress, and also how they're going to be able to guarantee that the FDIC will be able to cover some of these money that might be lost with some of these banks being closed down. I believe it's like 128 billion or something like that, like some crazy large amounts that we need to look into and see how the FDIC will be able to cover it. Like we said, the Federal Reserve will be printing up more money in order to help out with that. So going forward, though, they have to put that into the calculations. Inflation in the labor market is working hand in hand, and they're working to get it back, inflation, like we said, to that 2%, because it will help out with the economy. Also with the issues that they had from quantitative easing back in 2020, when interest rate was really low and a lot of money was getting loaned out to banks and to companies and to hedge fund management, all type of different money was getting loaned out. And now that the issue of inflation, now we have the quantitative tightening, which is making things harder for people to pull money or get money out of the bank or the Federal Reserve in order to, continue to help out the economy, like starting a business or running a business. So the Federal Reserve will be working on having price stability coming back, but they won't be doing any interest rate cut for any time soon. So we definitely got to keep our eye on the interest rate and how it will affect your bank account. Also going to be having the Federal Reserve Vice Chairman Barr will be doing an investigation into banks and the bank lending condition, and to find out what's going on and why some of these issues are happening. So it's going to be harder for banks to do credit trading between one another, and also we might end up looking like at a what they call a social credit score, where you're going to be based off of your past existence, social as well as credit issues. So it's going to be a different economy going forward in the next 2-3 years. So once again, it's NZD. Hope you got some value out of this. Let me know in the comment how the Federal Reserve interest rate hike of 25 basis point, and also going forward, more interest rate hikes will be coming because they said they will not be doing any cutbacks. How would that affect you? And also, how would that affect you at your job? How would that affect the company that you work for? Or if you into entrepreneurship, how is that affecting your business? Once again, it's NZD. Hope you got some value out of this. I'll see you next time. Peace.